When investor reaction favors job cuts, layoffs become a market lever, and your layoff becomes an equity value driver. Today on X, Jack Dorsey announced that Block will cut around 4,000 jobs. That's 40% of the company. He framed it as structural evolution. Simply, AI has changed how work is done. Smaller teams can now generate comparable or greater output. And the market responded positively. That's a directional marker. When investors reward workforce reduction tied explicitly to AI adoption, the signal to the rest of the corporate ecosystem is clear. Efficiency through automation is not defensive, it's strategic, it's forward looking, and it's investable. That changes behavior because executives operate inside incentive systems. If capital markets equate headcount compression with operational excellence, boards will ask management the obvious question: are we carrying labor that software can now absorb? And this is how structural waves form through incentive alignment. But let's step back and analyze the mechanics. AI doesn't eliminate jobs in one dramatic sweep, it disaggregates them. A role is not a single function, it's a bundle of tasks. Some tasks are repetitive, pattern based, predictable. Those are increasingly automatable. Other tasks require contextual interpretation, accountability, negotiation, trust building, ethical judgment. Those are far harder to encode. But when automation absorbs 30% of the tasks inside a role, the economic value of that role changes. Firms reprice it. Sometimes they redesign it, or sometimes they simply remove it. At firm level, this can improve margins quickly. Labor is often the largest operating cost of companies. Reduce it and profitability expands. Investors reward margin expansion because it implies scalability. At system level, the equation is more complex. If productivity gains accrue primarily to capital while labor income contracts or becomes unstable, aggregate demand weakens over time. Consumption is income dependent. Regional economies built on middle income stability begin to strain. Political volatility increases, social trust erodes. Efficiency and stability are not the same variable. The US model tolerates this volatility. It relies on labor mobility, capital flexibility, and market speed to absorb shocks. Cut fast, reallocate fast, grow fast. Europe is simply structurally different. It's more regulated, more coordinated, more friction in labor adjustment. And that is often framed as inefficiency. In this moment, it may be strategic optionality. There are two dominant integration logics emerging. The first is substitution logic. Identify automatable tasks, remove associated labor, increase margins, signal efficiency to markets, and repeat. The second is augmentation logic. Identify automatable tasks, redeploy human capacity toward higher value functions, increase productivity per worker, expand capability without hollowing out employment. The first model concentrates gains quickly. The second distributes gains more gradually but builds systemic resilience. Europe still has the institutional capacity to pursue the second model, but capacity does not equal execution. Execution requires discipline across three layers. Corporate leadership must move beyond simplistic cost reduction frameworks. Task architecture analysis should precede workforce decisions. If AI absorbs certain processes, what new value creation functions can existing talent move into? Can output expand rather than headcount contract? If the only objective is margin expansion to satisfy quarterly expectations, long term demand erosion becomes a risk. Policy leadership must treat lifelong learning as infrastructure and not rhetoric. Modular upskilling systems aligned to sector demand, portable benefits, wage transition mechanisms, incentives for SMEs to adopt AI as augmentation rather than replacement. Individual professionals must reassess their positioning as well. Titles are compressible, capabilities are not. strategic thinking under uncertainty, ethical oversight, cross domain synthesis, relationship management, complex design thinking with incomplete data. These are structurally harder to automate and will command premium value. The announcement from Block is rational within its framework. It's not emotional and it's not malicious, I believe. It's capital responding to technological leverage. But when layoffs are interpreted as a growth narrative, we must understand the incentive cascade that follows. If equity markets consistently reward headcount compression tied to AI, competitive pressure will drive imitation. Even firms that might prefer augmentation will feel compelled to demonstrate similar efficiency gains. This is how macro patterns solidify. Europe is not immune to these pressures. However, Europe retains regulatory and social instruments that can shape diffusion speed and labor transition. It can influence whether automation primarily displaces or primarily elevates. Under-digitized sectors offer room to integrate AI in ways that raise productivity per worker significantly without immediate mass displacement. That creates competitive lift without structural shock. But this window is not permanent. Technology expands productive capacity. Whether that capacity results in concentrated wealth or broader prosperity depends on institutional design and strategic choices. Europe still has decision space. The signal has been sent, but what happens next will depend on whether we treat this as a warning or as a blueprint.